Hey everyone, today I'm going to go over my go-to setup number one in trading. I'm going to explain all the rules, requirements, and guidelines of how to enter a specific go-to setup in trading. I'm also going to talk about what exactly is a go-to setup. I'm going to talk about, again, the enter criteria of a go-to setup. And I'm also going to talk about the risk reward management and stop loss. So pay attention to this one because I'm going to make series of these videos in the upcoming months or so. So I'm going to go over my first go-to setup and I'll explain kind of the rules of go-to setup. First of all, when you talk about go-to setup, it's something that repeats over and over again. So remember, it's something that has to continuously happen in the market, and it's not some sort of old and outdated strategy or method that doesn't really work in today's method. So in today's video, I'm going to go over three example of this particular go-to setup that happens really within the last month to now. So it's not something that's been back in years ago that doesn't really repeat anymore. And in terms of a go-to setup, it has to be some sort of higher probability of playing out in the desired direction, right? And it's something that traders have back-tested, reviewed, and practiced as well. Remember, it's not some sort of signals to buy and sell because a go-to setup requires you to wait for the confirmation, wait for the price to develop, and wait for the setups to shape up itself so that you see it over and over and over again in the market, and it gives you the higher probability of playing out. And the patience of you waiting for the right price action to develop, waiting for the confirmation to set up before you execute is the key to a go-to setup. So let's talk about this go-to setup number one. What exactly the criteria you need to do? So I'm going to go over this three examples here. So I'm going to go over Aussie dollar here as an example first. So first example, double top at a higher time frame. So it's very easy to identify the previous swing high of the price. Let's say this is where the price is at currently. What we want to generally look out for is that previous high of the price where that swing high will be. And does the price reach that previous high? Yes, it does. So that's the first requirement. And does the price move up correctively in that kind of a higher time frame or mid time frame or lower time frame within the structure? So does the price move up correctively? Yes, it does. So that satisfies both of the requirement of it. So let's look at the second requirement now. When we look at the mid time frame, it has to be some sort of ascending channel structure or other type of reversal corrective structures and pattern. So that could be a combination of head and shoulder, M&W structure and pattern, rising and falling wedge, or any sort of double top or double bottom. So let's take a look at this mid time frame here. So we have that double top on the higher time frame, and we have price moving up correctively in the corrective manner. Good. And we also have an ascending channel. We know ascending channel is usually a bearish reversal. And we also have price here, when we look at this part, it also has kind of a lower time frame double top as well. So the more that you can identify that satisfy your bias of that move, the better it is. Remember, we're looking for a bearish reversal. So you want to have as many bearish reversal type of price action. Double top, ascending channel, lower time frame double top, bearish reversal impulse. All of these are a good confluence, positive confluence for you to add it into that criteria that must be met before you enter a trade. So now, in terms of entry, look at here, we either going to enter at the very top of that ascending channel or a reversal corrective pattern, or you can wait for that reversal bearish impulse or some sort of lower time frame double top, double bottom. So that what that means is there's not just one type of entry when it comes to these go-to setups. You have to develop, and the key of looking at all these videos is not just copy and paste what other people are kind of telling you about. It's kind of develop your own way, your own strategy, your own entry criteria, because there is not just one way of entering the market. What we're talking about here is a setup that happens over and over again, but there are so many ways of entering these that you want to identify what works for you best in your trading plan, in your development, and your goal. So we talk about lower time frame double top. This could be initial entry already if you want to enter something like this because you already confirmed a bunch of things before. You already see that there is that higher time frame top, there is that ascending channel, there is a mini lower time frame double top. If these are enough, if you felt like these are enough of a confluence for you to enter, this is certainly a potential reversal entry that you can consider. But always remember, before the price has commit to the downside, remember we saw that impulse afterwards. Before the price has commit to the downside, it's always the riskiest when you enter something like this, but also the best risk reward when you enter like this as well. So pay attention to the difference with them, because right now at this time the price has not yet impulse down, which means there is potential for this to continue moving higher. So you might take a unnecessary loss here, and that is part of trading, or you might get a pretty decent risk reward trade. And really depending on what your trading tolerance are, what your risk tolerance are when it comes to this situation. Remember, there is no right and wrong when it comes to this. So when we kind of continued here, when we continue price, so either enter at the very top of the price, right? That's one method of entering, or you can wait for that first initial impulse down followed by a correction. So what that means is we're going to be looking for what that means is that we're going to be looking for the first impulse and move pushing to the downside, right? So you can see price push to the downside now. That is the first confirmation that the bearish impulse has happened. We already completed this ascending structure. Now the price is likelihood to correct. So that will be the scenario where it is more confirmed than we enter at the initial top. And of course, nothing is without its double edge. So when you don't enter at the very top, when you enter after the first initial correction, chances are the risk reward will be a little bit reduced because you potentially miss out a little bit of profit in that area. So again, back to my statement earlier, is you have to see how you are as a trader, what makes sense for you more to either enter at the very top, that will be more risky but more reward nevertheless, or you want to enter when there's a little bit more confirmed price action, and that could potentially give you a better entry that won't kind of spike to the top and take you off on unnecessary loss. So now that we see price have formed that continuation correction, you can either wait for a breakout entry or a correction after breakout. These are the three different entries that I utilize in my trading. I'm going to put the video link above so you can take a look at the top of your corner. That will show you the three different entries that we're going to talk about that I use. So in this example here, I'm going to opt in for a correction after breakout. So correction after breakout is simply just waiting for a smaller correction. You can see a smaller correction here after the initial correction here. So basically it's telling you that uh, the bearish move has happened, the larger bearish continuation has happened. I waited for a smaller correction after breakout. So I set your entry order, set your stop loss, and you're generally going to be looking for a 3-to-1 risk reward. So now that we're on this topic, we're going to talk about what exactly when we talk about risk reward management and stop loss. Over the years, I find that it is more subjective based on your trading plan, expectations, and goal. Remember earlier we talked about its expectation and goal of individual trader, because everyone will have a different type of expectation. So when I say 3-to-1 risk reward, it's a general rule of thumb, so to speak, where you want to risk 1% or a set amount equals, and you want to potentially get 3% or 3-to-1 risk reward. This is generally a more rule of thumb, so to speak, where you can be comfortable trading this type of method, because even if you take a series of losses, as long as you get one win that gives you 3-to-1, you can potentially kind of erase all the previous three losing trades. So it's something that you want to be kind of backtest and figure out what makes sense for you more. Remember, nothing is without its double edge. So when you don't exit the trade at 3-to-1, as example, sometimes price reverse. But if you exit the trade at 3-to-1, sometimes price continue. Again, there's no predetermined way to determine what the case will be for each scenario. So you just have to understand that whatever method that you choose to do, you stick to it. And of course, you can change it as time goes, as you backtest a little bit more, but make sure you don't allocate or jump back and forth based on emotion. Now, second thing you want to talk about is moving stop loss to break even once your price hit 1-to-1. It just simply means that if the price start hitting past 1-to-1 risk reward, a good protection, a good risk management rule is to just move the stop loss to break even so that it's a risk-free trade. So, but something like this, it's also subjective, because sometimes the price may reverse. So like sometimes price push down and then reverse back up, and kind of hitting your stop loss at break even and then continue down afterwards. And that happens from time to time as well. So it's one of those things, again, just like the 3-to-1 risk reward is, you have to understand which one makes sense for you to more and stick to it as much as you can. So slowly move down or up the stop loss as profit increase, right? Again, it's something that I developed over the years, where if the price continues down, it's good to start securing more and more profit. And even though price sometimes will create something like this, it can just kind of pull back here, basically just creating a smaller structure and then continue the downside. And sometimes if you move the stop loss too deep or too low, it might choke the price. But again, it's subjective and it's something based on your trading plan and your expectation. And over the years, I kind of developed into a way to say that it's really up to you as individual trader to understand what makes more sense, right? Because we cannot determine whether or not this particular trade that we enter is going to go straight down like this, or is it going to choppily move down like this. And sometimes if we move down the stop loss a little bit too steep or too deep, it might choke the price. Okay, so last one I want to talk about, be aware of news event, right? Because sometimes the volatility, the spread may happen, and sometimes our emotion rises because your trade is getting stopped out very easily due to spread, something that you want to be considered as well. So all that explained, let's go over the last two examples I want to talk about using this Goto setup. So let's go back to the criteria again. What do we want to look for? Double top on the higher time frame or mid time frame, right? So when we look at this production action here, when we look at the mid time frame here, do we have a swing high here? Yes, we do. Does the price hit that double top here? You can either break the high or approach the high. Yes, we do. And do the price move up correctively in that structure? Yes, we do. We have this kind of a rising wedge correction, moving the price up correctively. So that satisfies the first criteria. And do we have some sort of a reversal corrective structure? Yes, we do, right? We have a rising wedge. So, and now that we have a rising wedge, we have that double top, we have price moving up correctively. Good. Now we go down to the lower time frame now. In terms of entries, we can either enter at the very top of that channel or reversal corrective rising wedge, or we can wait for that first impulse down by the correction. So again, the example that we talked about Aussie dollar earlier was to talk about that either you can enter at the very top, so you want to enter at the very top when price just kind of broke that previous high, and then we start showing a little bit of bearish move. Sure, that's a possibility. Again, it might give you bigger risk reward. It might give you a better entry, but it might be more risky because it's at the very top of the structure and that first initial impulse has not yet happened. And that's why the second one, if you wait for the impulse followed by correction, so we wait for that first initial impulse and we wait for the first kind of correctional phase, you can see that there is a consolidation here and you set your entry order. Usually I would put the stop loss above the high of the correction and then let the trade run. So in this prime example here, I want to use this example as the one that we talk about in terms of management now. So we talk about moving the stop loss to break even once it hit 1-to-1. So that's a pretty good. So when price push down like this, once it hits about 1-to-1, you can move the stop loss to break even, which is a good thing to do. And you can see price slowly move down more and more and more. And at one point, almost hitting kind of the 3-to-1 risk reward, and I kind of have a pretty steep pullback. And this is the part about we talk about slowly moving up, down, or down stop loss as profit increase. And sometimes you can choke the price, sometimes you secure the profit if it reverses. So this is one of the chances where you have to kind of, again, make a decision, right? You can either, as price move down to about 2-to-1 or so, 2-to-1 risk reward, you can move the stop loss down to 1-to-1, and that might be a good way of securing profit if it does reverse. Or you feel like 3-to-1 risk reward is always your plan. You just keep your stop loss at break even if there's this pullbacks, you're happy to take a break even. And in this case, if you hold on to the trade, at break even, the trade actually continues to the downside and actually gives you to 3.5-to-1 risk reward. So again, I bring up all these examples to give you guys some sort of thoughts about your potential plan, your potential method, because all that factor in is that there's no way to predetermine whether this move will reach down to the desired target in one go, or maybe it does correct and move down, or it does push back pretty deeply and then continue. There is no predetermined way to identify that. Okay, so You just have to understand to come up with a method that you're more comfortable with, because you cannot be result oriented, which is what a lot of traders do. Don't be result oriented on the fact that you see this happen, so you'll always secure the profit or move down too deeply. And sometimes when you move the stop loss too deeply, you choke the price and then it actually continues down more and more. Okay, the last example, we're going to use dollar index as a example. So we're going to go back to our criteria again. This time is a double bottom on the mid time frame, price move down correctively in within structure. So again, do we have a double bottom? Yes, we do. Double bottom here, previous swing low, and prices at this area. We're going to talk about that's where the price is at. So, and then does the price move down correctively? Yes, we move down in this kind of a descending structure within this kind of range. So we satisfy that. And second criteria, we does the mid time frame, lower time frame have a descending channel, other reversal corrective structure, or other type of bullish reversal price action. So we have the double bottom, and we basically have a smaller descending channel within the larger descending channel on the mid time frame. So this is one of those patterns within pattern, structures within structure video that I went over before. I'll put the description above. And that basically adds confluence to a potential entry. So now you can either look for an entry at the bottom of that descending channel, or you can wait for the reversal bullish impulse or other lower time frame double bottom. So in this case, you can see price initially pushed down on the lower time frame very, very impulsively, and then quickly reverse back up. So this is what we call a reversal impulse happening on the lower time frame. This is a very good price action because you notice this over and over again when we zoom out here at the time. Remember, we factor in the higher time frame bottom, we factor in the mid time frame descending channel, we factor in the lower time frame descending channel as well, and we're basically seeing that lower time frame reversal on here, reversal kind of price action, reversal impulse, and first continuation correction. While this is still within the descending channel, this is a potential entry because we can look for entry either at the bottom of that descending channel or reversal kind of corrected pattern, reversal bullish impulse, or you can wait for the first impulse followed by correction. So in this case, this is the first initial entry. You could wait for the second entry if it does correct here, but this is a first initial entry. And again, you're looking for a general 3-to-1 risk reward entry, and price is pushing up. And as we go, you can see it does push up, and then it does reach to about the high of this descending channel before it kind of retraces down. So 3-to-1 risk reward again in this particular one. In this case, if we don't secure profit, remember the management page that we talk about, we plan for 3-to-1 risk reward, so we have to decide whether or not we're going to exit at 3-to-1 or hold longer, because in this case, when the price does hit 3-to-1, it did not continue right away. It kind of moved back almost down to a 1-to-1 risk reward, right? So I bring up these three recent examples to give you a better perspective on which method is better to use, which kind of management is better to use. These are a few things that you need to consider, right? There is no set answer when it comes to risk reward management stop loss. There is no one way of doing this, whatever trading strategy you use or style that you trade, right? So this is something that you always want to consider in your trading plan when you backtest a certain strategy, when you talk about a certain entry criteria. Look into these so that you know which one suits your personality more, and make sure you understand the criteria that's required to enter a setup that's going to help you to shape up, take less mediocre trades and focus on the best trades available. Okay, everyone, so I hope you enjoyed this quick educational video about a go-to setup, specifically what are go-to setups that you want to identify, what are the criteria of a go-to setup, and think about the risk reward management and stop loss as well. So any question, any feedback, welcome to let me know below, and I will chat with you all next time. Thank you very much.